whatever scale it looks like. Just worry about the next step so that you can actually get the capital you need.
I'm a big believer that a collective brain is better than one brain. And if you get a whole bunch of orthogonal networks stitched together, the better and the better and the better it gets.
I actually think a lot of like the best founders out there have I call it delusional optimism. It's like what you have to have in order to go after a feat like this, to build a unicorn company, to be able to take on this much risk, to go out there and work, 100 hours a week. You have to believe that you're the one.
Steve Jobs, we almost speak about him too much because he's so different than many people, but most people didn't like Steve Jobs. In my first book, Bob Pavey talks about leading the Series B round into Apple Computer, and he said, we really couldn't stand this guy, no shoes, smelled weird, dressed weird, insulting to everybody, awkward, but we really believed that the personal computer was going to be a really big thing, and they had a good technology and a good market position.
Hello everyone, welcome to the Startup Shortcut. I have my special guest here, Andrew Romans. He is the general partner of 7BC Venture Capital, a top VC fund. He's also the author of 3 books that have been published in 5 different languages, and he is close to finishing book number 4, which is Masters of Raising Venture Capital Funding. So if you're looking to raise capital, you're in the right place here today. He has also taught classes on VC as a university professor and is the host of podcast Fireside with a VC. So it's bound to be a really exciting conversation. Andrew, thanks for being here today.
Michael, thanks for having me.
Absolutely. So maybe what we can do, I always like to dive first in on a little bit of a background more so into your fund, what you're currently investing in. So why don't you just give me a little bit of a background on your core thesis, your investment that you're looking at right now in 2024?
Sure. So we're currently investing out of Fund 4, and the focus is capital efficient software companies that are primarily automating human workflows and tapping into data sets. So kind of the ideal company is got software that does the job of some human and it's priced less than what it would cost that human to do, or better yet, it's doing the job of a team of 12 humans. And, that's even better. Or what's most interesting is it's doing a job that would require thousands of people to do. But you'd have to hire Accenture and an army of people to do something, and the software just does it. So things are happening that was kind of up until now not even commercially viable or dreamable to do. It's kind of a fancy way of saying we invest in AI startups, but you say that, it's like, who doesn't invest in internet startups in 2004? And it's 2024 right now as we're recording, so it's kind of all that. But I do think that those data sets are super, super interesting and important too. But we're generally open-minded, and we could say we're generalists. What we do try to keep fairly strict on is that we invest in companies that have a minimum of 100K monthly recurring revenue. So annualized, that's like 1.2 ARR, annual recurring revenue, and an upper band of 500K, which is kind of 6 million ARR. We have invested in, sure, we continue to invest in companies with more than 6 million ARR, but what keeps us away is that if we consider there's going to be 50% dilution with VCs that come in after us, between our entry point and the exit, what's the valuation entry point? That exit's got to be like 20x to give us a 10x. Considering the dilution. And often they just get priced out, and big funds are happy to make a 2x, 3x, 4x because the funds are so big and 20% of that profit is a huge number. We're a relatively small fund investing out of a $50 million fund. So that's where we like to be, in that late seed to Series A is what we're calling it. But more specifically, first time in, entry point, 100K to 500K MRR is a really great signal for us. Geographically, heavily focused on the US, but we've done really well in Canada, and we invest in Canada too. We can invest anywhere in the world, but we can get into the many reasons why, but our preference is the US right now.
Yeah. I feel like that's a really important time in the startup life cycle. It's sort of like they have some sign of product market fit when they're doing 100K MRR. And it's kind of like it's really what defines, I think, whether or not they're going to have a successful Series A, Series B, and so forth is essentially what capital partners they get and what they use that capital for. I'm curious.
Sure. By the way, when I hear like a multi-billion dollar fund talking about all this early stage venture capital stuff that they do, I'm like, dude, come on. The company's got 100 million of revenue. You really think that the key decisions haven't been made yet? Thanks for the check. At the stage at which we're investing, it is critical to execute well enough and staff well enough and spend the money very wisely and don't make dumb investment decisions at the startup level to be able to build up the revenue for the second grade math for the next VC to be able to lead the next round. So for us, we kind of view our job as graduate these companies to raise a much bigger round at a higher valuation, but not too high valuation either, so that the next one and the next one and the next one come together as needed.
That makes total sense. Yeah, that makes total sense. I'm curious, first off, like, do you lead? And then secondarily, like, what do you feel like really differentiates you? Because I know right now AI is the hot topic, right? So everyone's trying to find the next AI startup that they can kind of get in around that point. So it's got to be a pretty tricky thing for you to be able to find and source deals at that stage. So what kind of differentiates your fund from other VCs that are trying to target similar stage companies? First off, and then also, yeah, just a quick question about if you lead the round.
Well, I jokingly say we have 99 problems and deal flow is not one. So, finding, and every startup is putting that label of AI all over themselves. So if you just want to check a box, it's checked for you already. That's why I try to get into some detail about like automate human workflows and API into different data sets that then goes into that automated software and is making decision trees, smart decisions in an automated, manner. And, and we like companies that are delivering value. Like one test question I always ask myself is, would I want to quit my job and do sales for the startup before pulling the trigger on an investment? And, is this must have? Is this nice to have in a tough economy for everybody? I mean, I kind of think, is the Fortune 1000, if there's going to be companies in the Fortune 100, Fortune 1000 that fail to adopt some of these new transformational technologies, and if they're slow in adopting, they're going to go bankrupt or be left behind or miss a huge opportunity or give up big opportunity, market share. If you're early adopter and you're good at adopting these technologies, you're going to crush your competitor. You're going to secure the future GDP of your country, or if you're in the US, you're going to gain market share and do well and self-actualize. So I think this is like do or die moment for all business in every country in the whole world. And the startups that we're funding is, I'm not looking for that next one AI. We're looking to build portfolios of 25 of them, and be concentrated to be able to help them and work with them, to move those things forward.
On that, actually, really quick, another point. I had a discussion with a founder earlier this week, and they were talking a lot about like their beliefs in fractionalized AI being like the main direction in terms of like very niche AI that's trained deeply in one specific niche. What's your opinion on that? For example, they serve like nurses, and they have a very specific AI, I won't tell exactly what they do, built to like improve that specific industry within the healthcare industry. What are your thoughts on that versus the more general copywriting,
that's sort of the
like
definition
Jaspers out there?
That's sort of the definition of what I was saying, automate human workflows and leverage data sets. So you look at the workflow in this nursing environment, whatever that is, and they figured out like some nurse stands up, chicken scratches on paper the notes, and then faxes it to the insurance company. The insurance company faxes it to the pharmacy faxes it back or makes a phone call. In the meantime, grandma's dying. To figure out how to automate those human workflows and digitize it, and then, automatically tap into data sets and like check with the pharmacy, check with the doctor, check with this, check with that. And then, it's just better. We should be able to deliver healthcare at a far higher quality at a far lower price, seamlessly and potentially make it free. So, that's what we see in that sense. I would also say, look at Palantir, Joe Lonsdale, Alex Moore's company, that, they started off, saying we're going to catch Osama bin Laden. And, if you've ever received a phone call from this bad actor who's on our naughty list, and you've been to Mogadishu in the last 5 years, don't ask me why, but apparently that increases your ability to be getting into trouble, and you've been geofenced in a hot mosque in London, there's going to be men in black following that guy around in 30 seconds. If they were able to do that for terrorism and national security type stuff and safety and police work, they could probably detect fraud in the insurance business. But that's a different idiosyncratic industry. And Palantir is a big enough, strong enough, great entrepreneurs, great backers to achieve multiple applications of their technology, going after multiple industries. I think I would agree with what you were saying, which is basically that every industry is idiosyncratic, and we need a Palantir for each different customized, unique industry. And the other thing is sometimes you meet founders in the kind of LLM dataset world that are saying like, I can help the military. I can help healthcare. I can help education. You name it, I can help you. I can help anybody. And I'm like, well, VCs are not as smart as you, and they like to kind of see profitable unit economics, that what's your CAC to LTV, and you're knocking out the job of 12 people in Basel, Switzerland, reading your clinical trial data. If the software does it like that and better, then boom, what's the salary of those 12 people, PhDs, and how are we pricing the software? The ROI is essentially guaranteed instant. It's boom, there it is. why wouldn't you pay the software? You're lucky we don't raise our prices on you. So, I think it makes sense for the entrepreneur to see all the applications that are technology. And it's often the VC or advisor, maybe you guys, Michael, that are saying, let's find one repeatable thing and start to make a wedge into a specific industry and say, our computers, our software can read all these PDFs very natural language process intelligently. And we've tapped into an insane amount of data sets to be able to give magical answers. And we price it really cost effectively with ROI for the customer that they can understand and see, and the CFO digs it. So I think it's useful to be a little vertical focused right now in 2024.
Yeah, I couldn't agree more. I feel like, sometimes people are overwhelmed by opportunity, right? They see all of those different use applications and then they don't really actually execute on any of them. And, what we always advise is very similar to what you just said. It's like, just prove it out in one channel. And if it works in that one channel, it'll scale. And if you scale by industry or whatever scale looks like, just worry about the next step so that you can actually get the capital you need to get to that next step.
It's hard. You got to know that it's hard for the founder because the founder's got what is my monthly income? What are my monthly expenses? What is my cash bank balance? When am I going to raise the next round? What's the appetite of investors to throw more money into my company right now? And then someone says, hey, could you do this for the US Army, but we need you to put it in a box that sits in a truck. And we're not going to go with your hosted solution. And it's tough to say no to a $10 million revenue purchase order from the US Army and continue to fight the fight in insurance. So it's hard to say no, but that's where it's good to have good people in the orbit around the founders and the CEO to have these discussions and don't just, jump off of every bridge where there's revenue being thrown at you.
Yeah, that actually is a really good transition for what I wanted to get into. I think that one thing that's really unique about you, Andrew, is two things First off, I want to hear more about the startups that you've been involved in directly that you founded, raised capital for in the past, because I think that it's just unique to have that perspective once you're actually going to be working with other founders. You've literally been in their shoes trying to raise, right? The other thing that I think is quite interesting about advice and advisors for these founders to make sure they're doing the right thing. One thing that I found really interesting for you was your LP situation and how you have them involved in the diligence process or even involved in the deal-making decision process. I'd love to hear about both of those two things, and feel free to just touch on that and educate me.
Yeah, I think some of this is a little bit of accidental. So it's I don't want to give myself credit for being a genius. It just kind of happened to us that, I've been in the industry my whole life. And so the first people to put their money into Fund One were kind of VCs, VC-backed founders, and these kind of people. And they were able to give us cash that we can use to invest in startups. But even more valuable than that, if they can meet the founders, they can help them with sales, they can help them with finance, they can help them with marketing. And there's kind of fractional services that they're not even charging for. If they take a board seat to balance out Benchmark or, more sharp elbow Series A guys, that can benefit the founder. Or the VCs are often on 40 boards. And so they're kind of not really present in there, where a lot of our LPs are only on 4 boards. So they're they can take that Sunday morning phone call when it's, do I sell or do I raise the next round? Or I think my head of sales is about to quit. What should I do? As opposed to, hey, we have a new head of sales. What happened to the last one? So I tend to think it takes a village to raise a startup. Meaning it takes a village to raise a baby. And if you put more people in the orbit of it, the better. And so LPs are the limited partner investors in our fund. And I'm an LP in the fund, of course. So is Mayron, our associate in San Francisco. But I think it's great if they want to be active, they can be active. And so we encourage LPs to leverage their personal business networks and their domain expertise to be able to open doors of any kind. And, it's pretty obvious to help our startups raise the next funding round. So that's a real core focus is if you get funded by us, we will guide you as best we can and we'll really streamline the process and professionalize your next fundraise and make sure that happens on time and with the best possible everything. Not too high, not too low evaluation, all that kind of stuff. And then as well as impact the exit and help with, getting investment bankers buying you lunch throughout the journey. And, when things heat up around M&A, they're making the best decisions on that. So I'm a big believer that a collective brain is better than one brain. And if you get a whole bunch of orthogonal networks stitched together, the better and the better and the better it gets. So we've got a lot of LPs from the Silicon Valley Bay Area, where I've spent most of my life. We've got the second biggest market for us is New York City. And New York is kind of seems to have moved to Wall Street South and South Florida and all over the place. And really, since COVID, things have been quite spread out. But we've always had LPs from everywhere and a lot of different countries. Canada, multiple countries in South America, Saudi, Switzerland, Germany, UK, Nordics, UK, Singapore, Japan, Australia. We're Africa. We've got investors from Nigeria and Ghana. So we're really spread out as a network. So even if a startup is thinking about entering a market, we can probably, dig up an LP that wants to talk to them. And then, having a network, unless you animate it, is worthless. So we do a lot to get people in the same room and they get a chance to meet each other and socialize and get to know each other over a period of years.
That makes a lot of sense. I'm curious, you said something in there about, you believe having like multiple brains is better than one brain, right? And I wholeheartedly agree.
The collective brain, yes.
The collective brain, yes. So one thing that I think also happens when you have too many opinions is they're not sure which person to listen to. So I'm really curious, on your thoughts for startup founders, like how do they handle having, 30 different people telling them how to run their company, which direction to go, who do they prioritize? And what are your thoughts on that?
Yeah, I've seen it. I've experienced it myself, and even with my own startups, people telling me like, "Oh, you should listen to this older person because they've got gray hair and they know so much better." And then kind of watching like Mark Zuckerberg do what he wanted to do and having the power to do it. There's a bit of what is the actual governance and who has the power, and then there is where you're getting your advice and how you're making your own decisions as an individual. And there's the politics of how to lobby others to vote the way you want and support and behave, pro and against things that are happening, within the journey. Sometimes things can get rough and it could be real combat. Sometimes someone's trying to replace the founder and the CEO. And so all this stuff really does matter. So pay attention to your board of directors. And in a world of convertible notes and safes, you often don't have a ton of, proper governance around the startup. Governance meaning who's on the board of directors, do they each have one vote? What's the relationship with you, the CEO? I tend to think of the CEO as the most important person and hopefully the founder. And so for the CEO, when you're giving a board seat to somebody, you better hope that that guy's going to be on your side or that gal's going to be on your side. And if you get into a Series A situation with like 2 seats for the money, the new Series A investor, 2 for the founders, including the CEO, and 1 mutually agreed to one, you want to make sure that you nominated that mutually agreed to board member and impress your VCs of, hey, I just dug up the former CEO of WorldCom or something impressive. And they love that person. They're so happy to know they're there to give adult supervision to you, the CEO. But you brought that person in. Hopefully there's some level of loyalty. That's your, appointment to the Supreme Court, as it were, that they're there forever, but you did appoint them, and you were involved in selection and there's something there. On how do you make decisions and where do you get all your advice from? I think it's important to listen to lots of people and triangulate information and then make your own decisions, in an effort to give you a short answer. And that's certainly what we do.
It makes a lot of sense. I feel like, there's that gut feeling, like you're the entrepreneur for a reason for a lot of founders. It's like you have a unique perspective. You should hear everyone, hear your counsel per se, but then make your decision because you're an autonomous person, right? Like use that information to then make a better decision. Don't necessarily just blindly listen. That's I think,
at the same time, in kind of like a lean startup world of, measure, get your accounting, your KPIs, iterate or pivot, it's important for a founder to, on the one hand, be persistent and stubborn and committed to a vision and be kind of Steve Jobs. If I asked you what you wanted, you would just say, give me a faster horse, never give me a car. That's something as a total forklift change. But on the other hand, I think a characteristic that is consistently there with every very successful founder and entrepreneur I know is being very versatile and flexible and listening to data and not just being an ostrich with your head in the sand. So if the world is changing and, like YouTube has become the total dominator takeover, your video sharing website might die and, and not benefit from the fact that YouTube is doing so well. So every little industry has got some industry dynamic, like we've backed LLM companies that have not done so well after the total dominance of, OpenAI and the, arms race that we're in on the LLM side. So it's important to, recognize what people are telling you and what the data is saying,
Yeah, absolutely. Sounds a little derogatory sometimes, but I actually think a lot of like the best founders out there have like, I call it delusional optimism. It's like what you have to have in order to go after a feat like this, to build a unicorn company, to be able to take on this much risk, to go out there and work, 100 hours a week. You have to believe that you're the one. But at the same time, if it's too much, then you don't listen to when you have to pivot. You don't realize when you have to make those changes. What are your thoughts on that?
I think that, Steve Jobs, we almost speak about him too much because he's so different than many people. But like most people didn't like Steve Jobs. Like in my first book, Bob Pavey talks about leading the Series B round into Apple Computer. And he said, we really couldn't stand this guy, no shoes, smelled weird, dressed weird, insulting to everybody, awkward. But we really believed that the personal computer was going to be a really big thing. And they had a good technology and a good market position. And then later everyone says he's America's greatest CEO ever. I think that it's a human characteristic that if you're a conformist, you're never going to be the one who has a vision and committed to the vision that everyone disagrees with. That results in a very different business, like even a Skype or something,
Yeah.
On the other hand, if the tide is shifting really fast, like if something like WhatsApp was coming out when Skype was coming up, that would have been a Skype killer. And in a way it was, but they successfully exited to eBay, for over $4 billion before that happened. So I think there's a mix of, you can see the mountain as an entrepreneur that doesn't exist. And other people are like, dude, what are you looking at? There is no mountain there. And so that's a special kind of reality distortion field, crazy Steve Jobs person to do that. And to be persistent when everyone is saying everybody wants a faster horse, nobody wants a car. At the same time, we are in a very fast, rapidly changing world, and you got to have people around you to let you know you're losing in the polls, dude. Let's pivot, or let's iterate, or let's do something differently.
Right. That makes total sense. I feel like, I actually was talking to a friend of mine. He built multiple companies. And one of his that actually failed, it was a competitor to like what's like TikTok today. And he was like, I was just too early. It's just like the idea sometimes is actually the right idea, but the time in which you're executing on the idea matters so much for the market.
It could be timing, it could be execution, it could be lack of a distribution partner. Like at the time that Skype was launched, they had their codec from Global IP Sound, GIPS. And so you could say, they had a good voice codec, but so did everybody. Everybody had a soft client and a soft switch to basically run an entire AT&T over a PC and anyone with a broadband IP endpoint. But the founders, Nicholas and Giannis of Skype, had founded Kazaa, which was a copycat of Napster in Sweden. And they had 11 million uniques going to their, music stealing, photo, video stealing website for Kazaa, where people were comfortable with peer-to-peer technology, unlimited bandwidth tariffs, which was not a no-brainer back then. And with 11 million uniques, they just advertised Skype, and that was the end of the story. So it wasn't so much a question of timing. You look at Google beating out AltaVista and Lycos and Yahoo and all the other search companies. It's like last mover advantage. MySpace had 25 million users and was, looked like a Mack truck you couldn't get in front of when Facebook came along. Some companies were launched before you had broadband edge speeds of fixed and wireless, or women were not on the internet. Social wasn't there yet. A lot of things are changing constantly.
It's really interesting. I'm curious, Andrew, tell me a little bit more about the companies that you started previously. Like before you started your fund, like tell me a little bit more about like what have you actually built before this?
Yeah.
Tell me a little bit about, just the journey there.
So I founded the Global Tele-Exchange, which was dealing with wholesale interconnect, voice minutes, and bandwidth. And you kind of have to explain how that whole industry works. But in the end of the day, we interconnected 150 telecom operators, including all the incumbent former state-owned monopolies and a whole bunch of emerging competitors. And we enabled them to post like a stock exchange on a website, offers bid and asks to buy and sell wholesale switch telecom capacity from each other, including minutes. And so you kind of have like a NASDAQ stock exchange connected to a physical telecom network where we raised over $50 million from Lucent to build next generation switches. And we were taking PSTN minutes, converting them over a signaling gateway to an all packet core of our network. So when British Telecom and Telefonica and AT&T couldn't upgrade their networks, they just put their minutes through us. That was like a real business in the late 90s and early 2000s. I then, had a company, Sentito Networks, that we made a box where you could switch in a blade for plain old telephony service, POTS. You could switch in a blade for DSL, or synchronous DSL or just gigabit or fiber to the home. So it's very flexible, slipping these blades in and out to help telecom networks, migrate. And then we had an automated customer support company where if you call AT&T or if your broadband is not working, we actually made the CD-ROM that did the install. So it costs like $20 per phone call. The average consumer, when first installing broadband at home, would make 12 phone calls at $20 a call to the call center. Very expensive. We made software that made 90% of those calls disappear. And then the 2 that get through, we say click a button with our software, which runs everything on your PC, and it shortens the duration of the call and fixes your problem kind of immediately. So that we were saving billions of dollars for telecom. That was enterprise software. I think 2 of the previous businesses that are kind of most relevant to what we do today were Georgetown Venture Partners, GVP. We were a professional boutique investment bank doing venture capital fundraising. So VCs would hire us after the dot-com crash to help their portfolio companies raise the next VC funding round. And so we were just professional VC fundraisers. And so we'd kind of take a very regimented investment banking approach to that. And now this is something that we do for our portfolio companies. We don't charge for it. So we think running out of cash is the number 1 cause of death. And you either get it from customers or investors. And so we really pay really special attention to how to help every portfolio company raise that next funding round. The other business, before I just got into regular old venture capital, was the Founders Club, which was a venture capital equity exchange fund. So in the old days, you had these founders that are worth I'm worth $100 million on paper, but I can hardly afford a lift ticket in Tahoe. And all my MBA buddies own cabins. I can literally barely afford the lift ticket while my kids are staying in that cabin. That back then you couldn't sell shares on the secondary market, which is quite common now. But what you could do is join the Founders Club and swap up to 10% of your ownership in your VC-backed company into a limited partnership that we managed at the Founders Club, where we would mix you in with 25 other startups that are all VC-backed. Then we would all go out to dinner and have everybody introduce themselves in under 60 seconds. And I say, hey, everybody here owns shares and everybody else that's here. At a minimum, let's introduce each other to our VCs to help everybody raise their next funding round, and bankers and M&A, hitman, divorce lawyer, whatever you need. And so that was the Founders Club. And so both of these characteristics exist now in the way we run 7BC Venture Capital, as we really focus on that fundraising and help you with the fundraising. And we do offer ability for guys to get equity in each other if they want to help each other, which sometimes is more interesting than just your VC for adding value to your company. And we're big believers in the secondary market, at least if the founders are selling and it's taking longer to get your money out of the, from an exit or an M&A, that if we invest in late seed and A, when the company is raising a big series C and D, and the valuation is up so much, we start selling like 5 small percentages of our ownership. So we return the fund faster. If you remember, LPs in our fund are often like normal accredited investor people that work in the industry or family offices. And if you just keep showing your LPs, oh, you're 5x up on paper, you're 7x up on paper, but we haven't wired you money back because we're waiting for this IPO and lockup or M&A that's never happening this year. If the valuations go up so much faster, we sell in the secondary market and we wire that money back. And when the secondary market was evolving within our Founders Club days, I got under a broker dealer and we were brokering the sale of secondaries. So we were like BD regulated and know all the ins and outs of like rights of first refusal, of do's and don'ts of how you get your money out in the secondary market. And in a world of stay private forever, I think LPs deserve to get their money back before investing in the next fund. And it's good to get your money back without waiting forever. And sometimes we're only selling 5%, 10%, maybe 50%. We're still riding our winners into the sunset.
That's a really unique strategy. And I think that speaks to like the success that you've been having so far with 7BC, quite frankly. The fact that you're returning capital like that to your LPs. And I think that, that's been what I think, actually I'm curious in your thoughts on this. The venture capital market right now is obviously down in general. Like it's more difficult than ever for VCs to raise LP capital, which I'm not sure a lot of startup founders realize. They think that VCs maybe be stingy or they're not actually understanding why they're not deploying capital like they used to. I'm a big believer that a lot of them are nervous about raising their next fund. They're being a lot more picky about the deals they're deploying capital into. We're not in 2018, 2019 when money was just flowing, right? It's also an election year. There's a lot going on in the world. So with that being said, I'm curious just on your thoughts when it comes to the VC LP the world that's going on right now? Like, what do you forecast for 2025, and how do you feel like startup founders should be positioning themselves to make sure they can get access to capital?
So there's a little bit of a tale of two cities, that if you're a large Sand Hill Road VC fund where your LPs are endowments and pension funds, multifamily offices, insurance companies, sovereign wealth funds, and your DPI, your distributions to pay it in, are bad, those big funds, they can't do what we do. They cannot sell in the secondary market like that. They're just too big. And so, some people accuse Biden as weaponizing the DOJ, and they're like stopping, M&A from happening and attacking every big M&A transaction. Or, Putin invasion, market correction. The stock market is trading at lower multiples in the last 2021 ZERP financing round. That exits have been hard to come by. So for a lot of VCs, their failure to return money to LPs means that the LPs are saying, we're not ready to invest in your next fund. And then the VC says, well, how much cash have I got left in this fund to deploy? We better slow down our investment pace, or we will become a zombie and we won't have money to make new investments. So there's been a slowdown, and there's a lot of good to that too. Like, there was some very dumb investing without doing due diligence or doing the work at dumb valuations that are happening. So, most VCs that are kind of OGs have been praying for a market correction, at the same time. And we got, our prayers have been answered, you could say. But it doesn't affect 7BC as much because we never really had the endowment pension fund LPs. We've got more single family office, high net worth individual, a lot of industry people, a lot of entrepreneurs that have sold their business. And our LPs are from very much all over the world as well. We're not just from Boston and New York. So for us, it's not been a problem. Our funds are growing, and we're still, super actively, we're seeking to deploy now. So we're very actively looking to make new investments ourselves. I think that the DPI problem of distributions, there's some signals that things are changing. And, we're seeing some big exits, like Wiz, that could return a lot of LP capital and breathe life back into the LP GP relationship. I remember when Waze was acquired, that navigation thing by Google, Magma was the big VC in it. The Israeli startup VC ecosystem was just not getting new money. And then when that one Waze exit happened, it just breathed oxygen right back into the body and kept him going. So hopefully we're at that point right now that we're about to see an opening of liquidity and companies exiting. There's also been we had to flush through the valuations of 2021 that, valuations came down, and companies are like, look, if I've got 30, 40, 50, $70 million cash in the bank, why should I raise a down round? I mean, I don't even need it. I'm just going to be a bit more cautious here. And then when offers come along to buy a company for $500 million and their last post money was 825, nobody wants to sell. And so there's a matter of 2024. I've grown into my 2021 valuation by truly growing revenue on lower multiples.
Yeah. I mean, that makes total sense. I feel like it was sort of a time of hysteria almost, people were investing without due diligence. There was actually just not quality investing. I think the correction was just bound to happen from everything that I've heard. I wasn't as in the space at that time, but that's just been the information that's been shared with me, quite frankly.
Yeah, I think I mean, there's a lot of good things to market correction, and there's a lot of bad things about, bad, stupid, FOMA driven investing at dumb valuation. At the end of the day, I said earlier, we look at what is the entry point valuation. If we invested in a company with a $50 million valuation and we want to make a 10x return, we need to sell and get liquid at a $500 million valuation. But if we do what we say we're going to do, we introduce them and there's 5 more funding rounds, then we got to exit at a $1 billion valuation to make a 10x on this simple 50 million entry point. And there were people investing at crazy valuations that were never going to get anywhere near a power law, to it. At the same time, there's been inflation at the exit side of the business. And, we never had multi-trillion-dollar valuations of the FANGs before. So when Facebook acquired Instagram, they paid $1 billion for a company with no revenue that was just days old. And that constituted 1% of their market capitalization, which was worth doing to stop photo sharing from leaving Facebook and going to Twitter. So they bought it on pure defense. You could argue, justified it. Now, with the valuations they've got now, to pay 1% of a Google market cap, 1% of an NVIDIA market cap, NVIDIA could be in a very different business if they wanted to diversify as fast as Bezos with their market cap, So we've never seen such big market caps before. Unfortunately, the U.S. government doesn't seem to understand how the economy works. when they're trying to block every single exit that hits those companies.
Yeah, that's going to be interesting how it plays out. Like I said, it's an election year, of course, so it'll be interesting to see what happens in 2025 and beyond, and if there is any change in policy right there. So I'm curious, actually, to talk a little bit about just like common founder mistakes that you see. So, I mean, obviously with your background, like raising 50 million plus yourself, previous ventures, you actually help raise capital yourself. Of course, it's something I hold near and dear to my heart. I'm just curious, like, what do you typically see if we were to break it up in two different sections? One, when it comes to like product, biz dev, just like typical issues you see there. And then the other side, just actual fundraising mistakes. Like, what do you typically see and what do you feel like you need to share to the world to try and solve right now?
Just for the sake of time and keep it focused on the theme of fundraising, let's just talk about fundraising. So okay. I think common mistakes are not understanding how long it might take to get cash in the door, and things are getting harder, not easier. I got off a call with a founder who's pitching, who I can tell is very frustrated that they've been in the market for a long time to close out this $2.5 to $3 million funding round that they're raising. And it's like, it's a young founder who's just like, what? Like, still getting the memo. It's not 2021 and that this shouldn't be so hard. And yet it is. So one thing is just don't run out of cash. Again, that's the number one cause of death. And so if you underestimate how hard it's going to be to raise the next funding round, that's a mistake. Another reason why raising the next funding round could be very difficult is that the last valuation of the last funding round was too high. And so I've already alluded to this, that you want to make sure that your valuation is not too low or not too high. Most founders have this classic mistake that they're born coming out of their mamas at birth screaming about dilution. That seems to be an innate thing that they all seem to understand. It's quite new and counterintuitive to them to think that we might have made a death blow mistake by raising a too high a valuation. I remember one time we had a company, it was founded by one of the first employees of Palantir, actually, and I introduced them to a corporate VC who then invested in them. And they just had a couple of trials of like 100K here, 300K there of revenue. And then all of a sudden, this big corporate came on and gave them 5 million quarterly revenue. So now they're at they went from 0 to 20 million ARR, or like out of nowhere. And all the East Coast New York VCs, not to slam them, but I guess I'm doing it, were saying, well, we should be raising at if we've got 20 million ARR, we should be raising minimum at a 250 million pre. So pre-money of 250, so that would be minimum like a 300 million post. And I said to the founders, if you raise with a 300 million post, this better be the last funding you need to get to profitability and an exit. Because first of all, who's going to buy this company for $1 billion to satisfy a 4x return for a growth fund? Now, I think a lot of growth funds, we all know, will take a 2x and a 3x and celebrate that. But if you are going for a 4x, which is kind of considered the conventional wisdom here, you're looking at who's going to buy you for $1 billion. And this is where we bring in our network. We have a lot of investment bankers that do nothing but sell venture-backed startups as LPs at 7BC. We bring them in from the East Coast and the West Coast to talk to the founder and say, show me a list of who you would put on the list of who you would introduce us to buy this company if the post-money valuation right now is 250 or 300. And they're like, well, you're going to have to IPO because I don't know anyone that'll buy this company for $1 billion on your 20 million in revenue, even if you grow it to 100. Like, there's not a lot of companies that can buy this thing and pull that off. Whereas if we had raised 10 on 40, so you raised 10 million on a pre of 40, you got a post of 50 on top of 20 million ARR. First of all, if you march around and say, I'm raising on a 40 million pre on 20 million ARR, that only happened like last month. Every VC in the Valley from here to Singapore is going to be throwing their name in the hat, sending a jet to pick your wife up on her birthday to try to win that deal. And now you can just point at who you want in your round, and you'll have the best of the best on your cap table. And you talk to that investment banker, and he's saying, all we have to do is sell this thing for 200, and we are de-risked like crazy. So now you raise 10 on 40 like that, put that money to work aggressively, knowing if things go bad, we can raise at 100 million pre and call it, we've 2x'd again. Everyone's marking it up. Everyone's supportive and happy. You've got fundraising options. You've got M&A options. The world is your oyster. And so raising money at too high a valuation is a common mistake that's often driven by a child VC and a child founder. And when I say child, it could be any age, but just stupid, And the founder might have been working on this thing for 7 years before the Series A came, and you're going to put everything at risk. You're going to put all these employees and all your family ownership that's concentrated in this one startup at risk because some Sand Hill Road VC wants a markup for their spreadsheet ahead of their next fundraise for their next fund. So that greed on valuation and dilution is really cancerously deadly as a mistake.
Yeah, I think that's a really valuable lesson to put your valuation for something that's attractive for investment, not necessarily for egotistical reasons, right? For just to have a high valuation for the sake of having it. It could actually be the thing that makes it a detriment to your fundraise.
Yeah, but the founder's doing second grade math with their second grade VC. They're saying if I raise money at a 300 million post, and I own 10% of the company, I'm worth 30, and we should be able to 4x that, and I should walk out of here with a Hyundai when this is all done and done. And look, Mom, I got Tiger Global on the cap table. Well, they sent Bain Consulting, and they never even spoke to you when they wired. So it's hard to quite understand that. And if they had raised 10 on 40 and sold it 200, the liquidation stack of what they had to pay off was only 10, 12, 15, 17 million in total. Right. And they're getting their ownership of the remainder, or it's non-participating preferred liquidation preferences. So at the end of the day, if you can bank a pretty sizable exit with big investors at a relatively young age, go be Steve Jobs on your next one and try to go public, but right. Secure your family, secure your reputation as, the person who founded a company and within 5 years sold it to Cisco. Sounds good to me.
It's definitely not a bad route, right? I feel like sometimes people are always going for the absolute pinnacle of an exit, an IPO, or else they're going to bust. And I just don't.
But if you're going to go through 7 more fundraising rounds and your last post was 50, you've got a lot of up to go. Whereas if your last post was 300 and you're not executing flawlessly, in that situation, we were concentrated in the hands of one customer that wanted to also buy us, which was conflicted. So a very dangerous position to be in, that makes if you want to de-risk your future and go for the pinnacle, make it so that your next round is a walk in the park to be an up round. There's a lot of down rounds happening as we recover from 2021. There's no shame in that. Down,
I was actually going to ask you about that.
Down is the new flat.
Yeah, I was going to ask you about that. So 2 quick questions before we start getting wrapped up here. So talk first about the down round. Should founders do a down round right now if they need cash? Yes or no? And yes, how low should they go? Do you have an opinion on that? Is there a metric or some type of threshold that you have?
How out of the market was the last valuation compared to the health of the business today by the metrics that the stock market and then dripping into the private markets are using today? Oftentimes a founder can find one investor that's hey, you got 6 million of ARR. I'll invest 100 million on a 900 million pre. And that's stupid by most accounts, but they might say, hey, I just got Instagram as a bargain, and they see something that no one else does. But in general, that down rounds are bad. And if a company is growing revenue year over year, if you raise funding and you say, how much am I spending a month? And what is my revenue per month? How much cash am I burning or generating per month? Most of these companies are loss-making. They're building products. They're going all in for growth. They're already connected to the venture capital machinery that they should be able to get introduced if they're executing well. Normally, you grow your revenue, and your pre-money valuation is a bigger number than the post-money of your last funding round. When things tighten up within the microeconomy of that one startup or the macroeconomic environment, then you say, look, we raised money before. We've doubled revenue, but we raised an extension of the last round that was flat. So if you raise money at a 20 million pre when you had no revenue, and now you've got 2 million of revenue and you're running out of cash and need to raise the next round, you could say, hey, 10x 2 million is 20. Let's just make this easy so that it just gets done. We're raising flat. It's an extension of the last run, same docs, small little thing, and you're raising the next bit of cash on a 20 million and everybody's happy. Then there's the kind of thing of we raised money at a redunculous valuation in the summer of 2021 and we made it last for a very long time, but we need to raise money. There's opportunities to get big chunks of revenue if we invest in ourselves and deliver it for our customers. let's raise at a down round and get it done. And at the end of the day, you say we're looking to raise this much, and you go on 50 meetings with VCs, and the market will speak to you and say, we're going to bid it up or we're going to bid it down. It's like putting your New York, Miami penthouse for sale at 10 million and people saying the market's willing to buy it for 6. We don't care if you bought it for 20 million in 2021. The market's willing to pay 6 for that. So there's a market price for everything. And venture tends to be pretty good at that, especially when you're hitting those later stages and there's real kind of revenue, CAC to LTV, payback, all these kind of ratios to examine. The market's going to tell you what they think. And down rounds that are internal rounds might be your only option. So I think we're seeing something like 1 out of 5 rounds is a down round. I don't even believe that. I think it's more than that. And it's not a function of the company screwing up. It's more a function of they raised in 2021 where the market was there, and now the market's there. Even though you've made a lot of progress, it's still a down round.
Yeah, and I feel like that's a really good way to look at it. I feel like sometimes they feel like it's like a step in the wrong direction when it's really like, look, it is just the fact of the market conditions, and it's what's going to keep you alive, and you're going to grow the business with the capital that you raise. It's either death or
there's a big difference between down rounds and pay-to-play rounds, where there's pull-ups and pay-to-play provisions where if you invested in the last 3 rounds and you don't invest in this down round pay-to-play, you're wiped out 100 to 1.
Got it.
And, we often can pay into that in one way or another. I feel bad. Like it happened to me that a small fund that introduced a deal to us and we came in and invested in it with them after them. When the pay to play happened, we had money and we made it our investment. So we protected our position, and the CEO let that guy get wiped out. And he hadn't raised another fund. And even if he had, he might have a policy of we don't invest across funds sometimes. Especially a pay to play, one that's not through the woods. So down and flat is a hell of a lot better for everybody than a pay to play pull up where you have punishing provisions for investors that don't follow on and put money in this new hell round.
That makes a lot of sense. Okay, so I guess we'll kind of wrap up here. A couple final questions for you. This has been awesome, by the way. Honestly, I'm learning a lot. I'm sure everyone who's listening is learning a lot. This is phenomenal. I'm curious. I always like to ask, big bets on AI. Like, what do you think is going to happen here in the next few years? Are you taking any big stances that you feel like are unpopular or kind of like unique?
I don't know. I think that, we've got documentation going back years and years and years, long before the chat GPT moment where everyone wrote love letter that rhymed to their girlfriend or wife or whatever, that we think that it's automate human workflows and tap into data sets and get those data sets to go back into the software and make decision tree data-driven decisions. And like your nursing example, you didn't tell us what that company does, but whatever that workflow is, to get automated and then tap into the data sets as opposed to the absolutely senile way that it's being done now. It's kind of like the world is broken, let's fix it. And we're kind of making those kinds of bets, and we're betting on companies that have 100K to 500K monthly recurring revenue, where we have a direct line of sight to 4xing revenue within 12 months, and we'll fund them for 24 months, and we'll run a fundraising process a year in that gets cash in the door where they've got a minimum 6-month cash in the bank by the time they close the next one. We'll be rational and discuss the right pricing and all that jazz. I think that, we're seeing big corporates with trillion-dollar valuations make big bets because if they don't, they're in big trouble. And you need to be careful as a startup or backer of early stage startups that doesn't have a war chest of trillions of dollars or hundreds and hundreds of millions of dollars to get into a nuclear weapons fight with a rock and a stick and a slingshot, So we're thinking we can invest in companies that'll make a 10x plus X for our LPs net of management fees. And, we've made some contrarian bets in the past. And when you're diversified, you can afford to do that, and say, this fund is already looking like a 7x, 8x. We can afford to completely lose this. And we've known this founder for a long time, and she's doing something crazy, and we share that crazy vision. It's not a total hallucination. Let's get behind her.
I feel like your thesis, I guess this is what's so cool about your fund. It's very similar to what you did as a founder, right? So you built software to automate the telecom example you gave of 15 calls to get someone to actually I can't remember the exact use case, but there used to be software to replace humans, and now the next level, the next iteration is really AI.
It makes everybody happier.
Replace.
Exactly. Grandma was way happier when she just installed the CD-ROM and she had access to the internet and she was on Skype. Before she's calling a customer support and they saying, "What operating system are you running, Granny?" And she's like, "What's an operating system?" And they're like, "Well, do you see a start button or an Apple?" And she goes, "Hold on, let me put the phone down. The computer's in the other room." That was like a disaster. The truth is, we saved British Telecom minimum 1.2 billion pounds. They only paid us a $50 million software license. I feel like we got fleeced, by them. They should have paid us a good chunk of the 1.2 billion pound savings, and they didn't. But, $50 million software license on a one-off is not a bad thing for a startup either. But I do think it's like, figure out a good business case where you're really making your customers love you. And you're going to make that Walmart destroy Kmart. You don't want to be Kmart getting ruined by Walmart. And I think that there's people doing idiosyncratic industries, applying Palantir to everything, that are going to do great by their customers and be able to launch into other applications and be able to solve for more things, but build a business that investors will support or could be grown on retained earnings and profitability.
I love it. Final piece of advice. What do you recommend? Let's talk specifically to late stage seed or Series A founders in that 100K NRR mark. What do you advise for people there or people trying to get there?
Well, I think at the end of the day, the one is never run out of cash, and it's all about execution, and execution's all about people. So there's fundraising and there's recruiting and there's managing. So, kind of develop your KPIs. What do we have to get done to make sure we don't get beaten out by competitors and that we can continue to grow revenue? I like to think we're more sophisticated than a lot of VCs, but I jokingly say second grade math. Sand Hill Road wants to see second grade math of it going up and to the right and a whole bunch of positive unit economics and payback cycles. So it is a bit of measuring and placing bets. And, we talked about focus. If the US Army is offering you 10 million in revenue, maybe you take it or maybe you don't. So hit those milestones so that you don't run out of money. You can raise that next round or tip into profitability and, decide if you even need to raise more money.
Makes sense. I think honestly, don't run out of cash is an incredible lesson. And it's like the simple thing that, founders need to keep top of mind that can absolutely change the game.
A final closing idea too, for that segment of the market that are where we like to enter 100K to 500K, it's never a bad time to speak to an investment banker that specializes in the small and big sale of the venture-backed startup, that understand the tech buyers, because they're going to be meeting with the head of corp dev at Google and Yahoo tomorrow. And if you let them buy you lunch and you tell them about your business, they want something fresh to talk about when they're in those meetings. If you start getting on the radar of some of those companies, maybe you want to specifically work to not let Amazon know what you're doing and they might play rough in, trying to take you out. But there's nothing wrong about selling your company early in the life cycle, early in your career, when the total amount of money that you've raised is a low, so the liquidation stack is low, you only raised $1.5 million, you sell the company for 15, 20, 30, 50 million, and you bank a few million, you prove yourself, and then get right back out there with another startup. So don't always think, oh, the other guys in my YC cohort are raising at 150 million pre-money valuations. Someone offers you 50 million, maybe you should take it. And those same angel investors and seed funds will back you immediately with your next startup. So don't be afraid of selling the business.
I love that. That's so true. That's so true. Well, thank you so much, Andrew, for your time. What's the best way for people to get in contact with you if they want to pitch you? What's the best way for them to follow you? I know you have your podcast, but why don't you let everyone know, and I'll drop the links here.
Well, yeah, we can drop some links in the show notes here, but Andrew at 7bc.vc is my direct email. I don't need a warm intro. I'm happy to hear directly, from founders, and you guys can find me on LinkedIn, and you can join our newsletter and learn a lot of stuff like this, exactly the kind of stuff we're talking about here today.
Amazing. Andrew, thank you so much for your time. It's been phenomenal hearing your perspective on the venture capital space as a whole. It sounds like you're doing some incredible work, and I'm excited to continue the conversation. Thank you, everyone who made it this long in the podcast. Pleasure as always, and I will see you in the next one. Bye.